there is so much uncertainty and so much potential for volatility, whether it be the policy outlook or inflation or what's going on in China, geopolitics. So what's your approach at the moment?
Well, good morning. As you say, there are a number of headwinds, and this has been a very different year than 2021. But I think first and foremost, the issue that investors globally are wrestling with is a very aggressive and rapid tightening of financial conditions. We have central banks rapidly raising rates in response to inflation. This has created a huge headwind for valuations for asset classes, from sovereign bonds to credit and obviously to equities. So what we've been doing, quite simply, we've been lowering risk. We're running a lower risk portfolio than we were 6 or 8 months ago. We've brought down our equity exposure. We are very underweight government bonds, and we've been very careful about our style risk. And again, I think this is in response to what is honestly a less hospitable environment than we enjoyed late last year.
What's your position in terms of the possibility of a recession anytime soon, and how does that set you up for more cyclical exposure at this point?
It's a great question. Here I'd actually be a bit more optimistic. We don't think we're looking at an imminent recession, certainly not a 2022 recession, particularly not in the United States. And clearly, we have a number of factors that are likely to slow growth, from higher energy, higher food prices, and of course, higher interest rates. That said, again, specifically in the United States, you have a very strong household sector with a balance sheet that's delevered, a strong labor market, significant savings. And on the corporate side, we're still seeing significant demand in capital spending. So I think you need to be careful about your cyclical exposure, but I don't think you abandon it. We have exposure today in energy, natural resources, select industrials, because I do think we're going to continue to be in an environment where companies that benefit from solid growth are going to continue to do well.
You don't expect consumption to take a hit given rising prices?
We do think consumption is going to slow, and particularly in the more rate-sensitive parts of the market. We're already seeing a slowdown in housing materials, and anything related to the stay-at-home trade that did so well in 2020 and 2021. That said, we do think that the consumer is in good shape for all the reasons I mentioned. What we are going to see, and it's happening in real time, is a shift in consumption. People binged on many goods during the pandemic and the lockdown, electronics, home furnishings, et cetera. And now they're shifting that spending to travel, to restaurants, and we think that trend is going to continue through the year. So it's not that consumption collapses, but it does evolve.
Energy, commodities, metals, how do you approach getting exposure to that? And I guess in a also related way, how are you approaching the transition trade, the green trade, given the pressure of high prices and limited supply?
Yeah, it's a great question. I think the short answer is you want exposure to these themes, actually everything you just mentioned. So energy, metals historically have been some of the most effective industry tilts when inflation is high and accelerating. And that dynamic is very much held so far year to date. Energy, of course, the best sector. We continue to hold traditional energy, but we also have been investing in infrastructure. Again, energy security is going to be a very important theme in the U.S., in Europe, and much of the world. Right. The companies that create those pipelines are definitely part of what you want to have in your portfolio.